Hello there, my name is Kevin Carlson. I'm a mortgage broker here in Canada. One of the most unhappy tasks that we as mortgage brokers have to do is help our clients with a mortgage in conjunction with a separation and divorce. It doesn't really matter whether it's a marriage or a common law relationship, the treatment is more or less the same. A couple that has been together for long enough to own property or have joint debt and assets is financially intertwined, just like an incorporated company. Separating a couple financially is no different from the sale or closure of an incorporated business. Couples that treat separation and divorce like a financial transaction come out way further ahead in many ways. If you own a home with your spouse and you are separating and getting a divorce, then there are two basic ways that you can proceed. The first is merely to sell the home and each go your separate ways. The second is if one spouse would like to retain the family home and the other spouse move on. What needs to happen is the spouse that is leaving needs to have their name removed from the mortgage. Typically, that spouse is due an equity share of the value of the house. If the spouse that is remaining in the home doesn't have access to cash funds to be able to pay out the other spouse, then typically that is done in what's called a mortgage refinance. A mortgage refinance is when you take out a mortgage for more than what is currently owed on it in order to access equity. The current mortgage rules in Canada limit mortgage refinancing under normal circumstances to 80% of the home's current value. So if the home is currently worth $300,000, then that is limiting the next mortgage to no more than $240,000. Under those mortgage rules, a mortgage of 80% of the house value may not be enough to be able to give you access to enough equity to pay out the other person. However, in the event of a divorce, the mortgage refinancing is allowed right up to 95% of the home's value. So in a previous example of a home valued at $300,000, a mortgage refinance in the event of a divorce of 95% gives you a new mortgage of $285,000. No matter which way a couple decides to go, there is one key document that each will need in order to process their next mortgage. The final separation agreement is a legal document drafted by a lawyer that outlines the financial settlement. It splits up the assets and the liabilities and outlines any ongoing payments like spousal or child support. It took me less than 30 seconds to tell you about that, but a separation agreement can sometimes take quite a bit of time. Sometimes months or even years to come to a full financial agreement. So what happens if the separation agreement is just taking too long? And in the interest of family harmony, somebody wants to move out. If that person is looking to rent, that's certainly fine. But if you're looking to purchase the next home, that could be a little bit more difficult. Without the separation agreement, more than likely the marital home has not been sold or the equity share has not been figured out. In order to be pre-approved and get a mortgage for your next home, you must demonstrate that you can carry both properties. Even if you're not making the mortgage payments yourself and the other spouse is, if your name is on that mortgage, you are financially responsible for that home as well. So your income must prove that you can support the current home as well as the next one. If there are children involved, things get a little bit more complicated as well. The lenders are going to want to know if there's going to be any child support or spousal support payments. Some of the lenders that we work with will let us use the online calculators provided by the federal justice system for estimating child support. You plug in your gross annual income, the number of children, and the province that you live, and that will give you an estimated child support payment. Another wrinkle in the process is the down payment. Typically in a situation like this, it's the financial settlement is where your down payment is, or the sale of the house. Since the separation agreement hasn't been signed and the financials haven't been figured out, you're going to be responsible for coming up with your own down payment. The minimum down payment for you to buy a house for yourself to live in is 5% down. If you have access to the 5% down, that's great, but you're exposed to some fairly hefty fees when it comes to default mortgage insurance premiums. If that's all you are expected to be getting out of the settlement anyway, then perhaps this is not a bad way to go. If you are looking to get more out of the financial settlement or from the sale of the house, it might be a good idea to look at waiting until that's all figured out. Saving on those mortgage insurance premiums is thousands of dollars that you can put back in your pocket. If I can give one piece of advice to any client going through this process, work cooperatively with your spouse. Get on the same page as much as possible. Now, I know that's a pretty stupid thing to say. If you could get on the same page about anything, you probably wouldn't be getting divorced. It is in your best interest and your future happiness to work cooperatively as much as possible so that you can both just move forward. Thank you so much for joining me on my channel today to learn a little bit about mortgages in relations to separation and divorce. If you have any questions about this type of mortgage or any other, please contact me at my website or feel free to comment below. Thank you so much and have a great day.